Kia ora and welcome to Shared Lunch, brought to you by Sharesies. I'm Helen Matterson, and today we look at what it's like to invest in times of conflict. The Israeli-Iran-US ceasefire is fragile at best, but it's been a nerve-wracking time for investors. To find out what all this means, I'll be joined by Nicholas Bagnall, who is the founder of the global equities fund Te Ahumairangi, and our own Sharesies, Matt Macpherson, who is the head of KiwiSaver. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Nicholas, and welcome, Matt.
Thank you. So,
the US markets seem to have taken in their stride, if you like, the conflict that we've been seeing that's been playing out in the last fortnight or so. Nicholas, I wanted to start with you and to see what you thought about this business of riding back into positive territory when it is a time of conflict.
Yeah, I guess at one level I am cautious about the level of equity markets, but I don't know that the conflict necessarily has wide negative implications for the share market. It's there are very few Western companies that have much revenue from Iran or even from the Middle East in total, which is different to, say, the Ukraine-Russian conflict, where you had quite a few Western companies that might have had 2 or 3 or 4% of their revenue coming from Russia before that conflict broke out, and that essentially disappeared for them. So the main implication for companies that are operating in Europe and Asia and North America is what it does to the oil price.
Yes, oil has gone down, up, and it seems like any gains that it have retreated. That didn't seem to happen, from my memory, with the Ukraine-Russia situation so quickly. What is happening with the oil prices? What are the reasons why it might have fallen again?
I'm no expert on it, but I think it's because Iran's done nothing as of yet to block the Straits of Hormuz, which takes oil in and out of the Persian Gulf, which I think is about 20% of the world's oil production moves through there. And that was the major concern that saw the oil price moving up as this conflict was starting. It is still affecting oil supply, because I gather that a lot of shipping companies aren't particularly keen to send ships into the Persian Gulf. But the world has been well supplied with oil in the last few months. Even when the oil price spiked up, it's I think still lower than it was a few months ago. So it's not at a level that's causing stress for many companies.
As you say, we're not quite sure where this will all go. I mean, the big question is where or what Russia may or may not do. And it may not be immediate, it may be a bit further down the track. And there has some commentators have suggested that they would want to kind of flex their muscle again in the Middle East, and that they might even help in some way to get Iran's nuclear capability back in some form. What's your view on the Russian situation?
I don't think the Russians want to be involved. Again, it looks to me like Putin is all about Russian self-interest. He's not a man of principle, and they were mates with Bashar in Syria, but they didn't intervene when that regime fell. So I'm sure they'll use it to point to hypocrisy between the US and Israel breaching international law, while they were condemned when they did it with Ukraine. But they're fully occupied with Ukraine. They're struggling there. I don't think they want to divert any military resources to Iran. And
what about our biggest trading partner, China?
They were happy to buy oil from Iran when the rest of the world was boycotting them, but I don't think that they have any interest in getting involved. So, yeah.
We shall see times ahead.
Yeah.
Matt, I'll bring you in here. Speaking of conflict and times of conflict, we have launched today, Sharesies, the self-select for the KiwiSaver scheme that we run. And some would say, gosh, why would you be doing that when we've had a week like we have? So, yeah, keen to get your thoughts on that.
Yeah, we launched about 55 companies and ETFs from the US markets this morning. And I'm not going to say we weren't paying attention to what was going on, but I guess... this US trading feature's been our most commonly requested feature from customers. We've been on this for several quarters. Our plans to bring this to life are phased over weeks. We have a lot of delivery and testing and things that we go through. So I guess we just took our own advice, which is don't try and time the market. And so when we were ready, we rolled out. That happened to be today. But yeah, nervous over the weekend about what was happening for our scheme. I guess also just nervous about what it could mean, for the world and all the people who are in terrible situations as well in that part of the world.
Yeah, we must remember that too. So far, Sharesies investors seem to have not taken the fear too seriously with the conflict. There haven't been lots of selling or panic or anything like that. Do you think there will be a bit more caution with something like this, though, given the situation? Who quite knows where it's going to end?
Yeah, I think so. I mean, 2025's been pretty choppy. We had Liberation Day in April, which was around the time that we launched another US-themed fund. And I guess what we see more and more is a really mature kind of approach from investors around volatility. There has been a number of significant events. I think people learned a lot from COVID about acting on emotion, certainly with respect to changing their KiwiSaver kind of their funds. And I think people, you can be upset, you can be concerned, but I think what people get, and I speak to a lot of customers about this, is they get that the worst thing they can do is actually act in haste and try and switch their settings off the base of sort of sentiment and things like that. So back to the basics, understand your investment horizon, your ability to be able to deal with volatility, and then let time work for you.
Nicholas, you've been investing professionally for more than 35 years. You've seen conflicts come and go. I'm conscious to see, and a lot of that was actually with ACC, wasn't it? I mean, probably the majority of that time was with ACC, and you're picking stocks for wholesale and retail investors. I'm keen to see what your views are on how to protect the assets of investors, particularly in times of conflict. I mean, you will have seen a few. What would you say to that?
Yeah, we follow a sort of a lower risk approach. So we emphasise investing in low to average risk companies and avoiding volatile companies where we don't have good visibility about future earnings. And that does mean that we the fund that we manage, it tends to fall a lot less during market declines. So certain types of companies, cyclical companies, or ones that are trading on high valuations, are more vulnerable in times of uncertainty. So rather than relying on making timely decisions when conflict breaks out, we at all times tend to hold companies with a relatively certain future that won't be too affected by a spike in the oil price or something like that. I mean, you can still get caught out when when Russia invaded Ukraine. We had some companies that did have a little bit of earnings from Russia, and that hurt us in a very small way. But so it's partly about diversification, but it's also about not investing too heavily in companies that heavily dependent on economic conditions. And over the long run, even though investors have done well from taking risk when they move from bonds into equities, within the equity market, there's been no better return from the highest risk companies than they are from the lowest risk companies. Yep. So there's no reward for risk within the equity market. There is from moving from fixed interest into equities. So we prefer to invest in low risk companies within the equity market.
Because you still think you can get the returns, or history has shown you can get the returns, as opposed to sticking with the high risk, which everyone jumps into and has FOMO and all of that. Yeah. Okay. And that said, though, you need to be able to research those companies. For the poor old retail investor who's kind of looking around and seeing what their friends are doing and everybody else, that might be a bit more difficult, mightn't it?
Yeah. Though generally, I would say it's easier to research less risky companies than it is ones at the more volatile end. Because if you're buying a Tesla or an Nvidia, you're really guessing about what they will look like in a future that looks vastly different from today. If you're buying a regulated utility or a company that's selling something like laundry powder, that market's not going to be that much different in a decade's time than it is now. And if market shares shift, they shift slowly. We as a general rule, we find companies where you can be relatively certain about the future are also the least risky ones.
Right, okay. Matt, if we look at the self-select KiwiSaver launch that we've got, that's as you said before, 50 plus stocks. Are there any defence-related stocks in that?
Yeah, I wouldn't say there are any that are specialist defence companies in that list. There are a number of companies that are classified as defence and aerospace sector within the index, within the S&P 500. Mm-hmm. So companies like Boeing and Lockheed Martin and names like that, they're categorised. Those are not companies we offer individually, but they are components of several of the major indices.
So through ETFs, I could be investing in those, is what you're saying?
That's correct. And then there are other companies that have defence contracts. So companies, Palantir's a pretty well-known company that has defence contracts, even though it's not segmented as being a defence or aerospace company itself.
I suppose it's defining what defence is, isn't it? Whether we're talking manufacture of weapons, but there's many aspects, isn't there? It's quite a general term.
Yeah, it's a challenging area, I guess, because companies probably like Coke and Pepsi and things probably supply to the Defence Force, and so, but I wouldn't say that they're defence-orientated companies.
Interesting, isn't it? Yeah. Nicholas, if we look at the US dollar, that always has a bearing, particularly given it's sort of like the global currency, if you like. I do note, though, that it went up and it went down, a little bit like the oil price, I suppose. It does seem to be, though, that its popularity is less than perhaps during other conflicts. I mean, we've seen a lot of sovereign funds, some central banks, considering their reserves being in other things besides the greenback. I'm just keen for your perspective on the US dollar and whether we think that has a bearing on obviously you're investing in the US. I think 47% of the fund is in the US. Yeah, so how does currency correlate with investing offshore, particularly the US currency?
Yeah. It is an essential part of your portfolio of risks. I mean, generally, if you're investing in companies that operate globally, there tends to be a partial offset between local currency share price movements and currency movements. So if you're buying, the likes of Microsoft or Apple that are selling around the world, if the US dollar goes down, then the value of their non-US revenues goes up, so you get a partial offset. I don't have any strong views on the US dollar and certainly how it should be affected by the outbreak of the conflict, it has tended to be very much at the margin to be a sort of a bit of a flight to safety sometimes. And during, currencies like the yen have tended to be more, have had a stronger tendency to outperform during market weakness, but they don't necessarily when it's to do with strong oil prices, because they are net importers of oil. Yeah. But the US economy has a lot of issues with big fiscal and trade deficits, and certainly the what Trump is talking about doing in terms of the sort of revenge taxes could turn a lot of people off investing in what is already the world's most expensive share market. So
yes.
There are risks to holding that much exposure to the US dollar.
I guess what we see talking to customers is the big brands coming out of the States that are global, that people buy from, are often the ones that people also want to own a part of. And I guess that's why we have so many people asking us, when we're going to include some US companies in our KiwiSaver. People feel quite strongly about some of these brands, and they've been lifelong customers of them. So I think it probably comes at it for us as more of a consumer kind of led demand, rather than the pure, technicalities of investing, I think.
Nicholas, just thinking about New Zealand and whether or not this conflict, and with an investor lens, whether that has any bearing for people here or our economy, inflation, for example. There has been talk that if oil prices do rise again, it'll be inflationary. Just, keen on your perspective.
Certainly, if oil prices rose a lot further than we've seen so far, they could have a bearing on inflation, and the New Zealand dollar is also can have a big influence. It's so New Zealand dollar's obviously off its lows, which is deflationary. But
that's right. Yeah, Matt, in terms of the KiwiSaver funds, if oil prices were to rise and it was inflationary, what would there be an effect there? Can you explain what perhaps could happen?
I mean, the classic scenario is that if oil prices go up, businesses' costs go up. They pass them on to consumers, which is inflationary, and then central banks around the world will want to step in and try and curb that by increasing interest rates. Increased borrowing costs is generally not good for businesses. And so, oil prices increasing, I think, translates to a headwind for business, like globally. Now, that's kind of the theory. I don't know what's going to happen in this situation, but rising oil prices translates to a lot of pain for a lot of people right throughout the system, I think.
Maybe a question for you, Nicholas. I mean, rising oil prices, is oil as powerful as it used to be as we decarbonise? Isn't it eventually a sunset industry?
It is, and certainly oil consumption as a proportion of GDP has come down over time, so it's less important than once was. And certainly, I mean, in terms of dollars, when you're talking about whether it's $60 or $70, that's that is less significant for companies and for inflation than when you were talking about 120 or 140.
Yes,
it's sort of it's certainly what we've seen so far in the conflict is not really moving the needle that much. And as I said before, I think if you look back at the start of the year, we probably had oil prices a bit higher than they are today. So yeah.
Yeah, that's right, yeah. Matt, just getting back to something that you said before about investors and getting more used to volatility, what about if you don't have a lot of time, or that you're thinking you might like to get a deposit for a house? What can people be thinking about? What can investors be considering given that there could be more volatility, or it's about riding it out?
Yeah, I think I'll just repeat like a really well-trodden line here, which is understand your investment horizon. If you are looking at investing in equities, have a 10-year horizon. If you need your money back in less time than that, then think about a more conservative allocation.
As in, you're thinking?
Yeah, look, it all depends on that time. I mean, within a couple of years, you'd be looking at certainly looking hard at conservative funds. 2 to 5, balanced funds. We've seen a lot of people over time end up in situations where they were trying to take their money out at exactly the wrong time. And with hindsight, those people realise that they should have understood their investment horizon.
Now, I want to ask you both, before we finish, what should investors be thinking about when there is conflict in the world, given that a lot of our investors, particularly, are invested offshore? Nicholas? I
mean, I would caution against making changes to your portfolio because of the outbreak of conflict. And good investment is about choosing a portfolio where you shouldn't have to change it, where you don't suddenly realise you've got a risk when conflict breaks out. So, I would. I mean, sometimes market reactions or lack of reaction can create an opportunity, but there's no. It's going to be different each time, so you shouldn't think that there's some simple rule that you should buy something or sell something when conflict breaks out. We're always looking at companies, trying to forecast what future cash flows we think they can deliver to shareholders, and see is that a good return, and is it better than we can earn elsewhere. So we're repeating that in analysis whether we've got conflict or not, but it's not. There's no simple rule that you should buy A and sell B when conflict breaks out.
Matt, what's your perspective? Because, I mean, a lot of KiwiSaver investors probably, listen to the news or watch it and, on social media, and we have a lot more coming at us now. And it might be harder to resist fear or whatever might be happening at the time. So, what's your perspective?
Yeah, interesting. On the weekend, I saw a number of professionals and commentators advising people not to look at their KiwiSavers again. And it's good advice, don't get me wrong, but it's also not the advice that those professionals follow themselves, and so if it's really good advice, then it should be for everyone. I think just contrary to that, I think confident investors are comfortable with volatility in portfolios. They realise that that's an element of a healthy market, and reflects that they've got risk in their portfolio, which over the long term, risk equals, translates into returns to some degree.
Depends on which type of risk.
Yeah, 100%. But I guess the point is, I'm not a believer in ignoring it. I think to become confident, I don't think you should always put your head in the sand. I think the only way to get comfortable with it is through some experience.
Thanks, Nicholas and Matt, and thank you for joining us. You can watch Shared Lunch on YouTube or follow us on your favourite podcast app. Leave us a rating and tell us what you'd like to hear next. Mā te wā.